This is the Financial News Network. I'm Christy Duffy. AOL reporting third quarter earnings results. The company posted double the profit, but AOL's ad business is still weak. Revenue was down 26% year over year. With me to discuss the web services company is Clayton Moran of the Benchmark Company. Clayton, how did the quarter compare against your own projections?
The quarter was essentially in line with our projections and with the street expectations. Revenue was down 26% year over year, very modestly above the expectation, which was down 27%. And the cash flow performance was similarly just above the street, but I would call it basically in line with expectation.
How did AOL's ad business fare?
Yeah, the ad business, continues to shrink pretty rapidly. It was down 27% year over year. But as I said, that was expected. And you could argue that their core domestic display business, which was down, I believe it was 8%, it has improved and isn't declining, as rapidly as it once was. So that's maybe a minor positive. But for the most part, the ad business continues to struggle.
How is traffic on AOL's sites overall? Has it been growing?
No, the traffic is primarily, or at least largely, driven by the Internet access subscribers that AOL has. And those subscribers declined from 5.4 million a year ago to only 4.1 million this year. So as you can imagine, a lot of traffic is lost as those subscribers churn out. So the overall traffic, is down, not as dramatically as that drop, but they are seeing less user traffic on the overall AOL properties.
Okay, AOL has been making a push into the hyper-local sites like Patch.com. Can you offer any insight as to how that could become material for the overall business?
Sure. That AOL believes that local, and I think they're rightfully thinking this. Local is an area of online that represents a nice opportunity for a company to come in and build a business. Local has been addressed by Google and others in certain ways, but not really to the detail that AOL is trying to do with its Patch initiative. What they're doing is going into communities and creating content around that community, restaurant reviews or local high school sports information, other stuff that's very specific to that community, which could clearly draw interest and maybe in a way, replace the traditional local newspaper. So AOL's building this town by town, essentially, and it's a major project. And if it's successful, it will create significant advertising opportunities for them. But they even said today that the next 2 years of Patch will be all about investment and building the content and building the user base, and they don't expect to really make much in revenues, let alone profits, on Patch. So Patch is an initiative for really long-term growth and not something that is likely to contribute to revenues and profit anytime soon.
And AOL being the weakest of the search advertising platforms, how can the company compete with Google or Yahoo given the share of ad dollars that go to those larger companies?
Right. It's trying to compete primarily with content. So it's really focused on the display advertising segment of the market. Although they do get search revenues, you're right. They really feel like they can compete on technology and of the scale of a Google and a Bing. So they basically use Google's search engine to power their results and focus on the content and display advertising side of the business. And how they're doing that is trying to build things like Patch, but also the AOL.com website, which was just relaunched, redesigned on Monday, and other things like email, obviously, and instant messaging. But also they have these niche properties such as FanHouse and TechCrunch and sites like that drive traffic. So it's really content play with several different properties and trying to monetize it with display advertising, which I would say compared to search is much more fragmented and therefore a bigger opportunity to gain share, and probably is AOL's best bet to turn around the company.
Well, AOL shares have been on the rise this quarter. Where do you see the stock heading, and what's your rating?
We recently downgraded the stock from buy to hold. It has done very well, up from about $20, $21 to $27 per share today. But we think there remains significant uncertainty around the company's ability to turn around the advertising business. CEO Tim Armstrong mentioned on the conference call that he felt they could do that about a year from now, which would be great, but obviously there's a lot to be proven between now and then. So, and of course the company is shrinking at a pretty material rate today. So there's a lot to be proven. There's a lot of uncertainty around the company's ability to execute and grow. And as such, we think it's trading at about the right range right now. It's trading at a valuation multiple of cash flow that is above its internet access peer, Earthlink, because of course AOL is basically still largely a internet access company generating all its cash flow from the access business, but it's trading below the valuation multiple of your online advertising companies like Yahoo and ValueClick. So we think it's right in a fair trading range.
And there's been recent talk about a potential deal to merge with Yahoo. What's your view on that?
Sure. So the Yahoo deal rumors that have to do with AOL really revolve around Yahoo and not AOL. It's predicated on the idea that Yahoo could sell its Asian properties, generate a bunch of cash, therefore make the takeover by AOL and private equity much less expensive, and AOL would bring Tim Armstrong and his management team and some added advertising properties to Yahoo. So there is sound reasoning there. There is sort of a compelling catalyst to do the deal, and that is the hidden value of the Yahoo Asian properties. But we think the likelihood that it gets done is low because it's very complicated, requires several different parties, and I'd say it's even lower that AOL is involved because AOL's involvement is really not a driving force behind that deal. And if Yahoo wanted to hire Tim Armstrong or a great new manager, that probably could happen without actually buying the whole company. So there's a lot of moving parts. There's a lot to put together, and we think it's also not necessarily something that Yahoo's management would agree to. Obviously, Yahoo had an offer from Microsoft a couple of years ago, and they resisted at a very high valuation. So Yahoo seems, I think, probably reluctant to do a deal down here at these levels. So you have a lot of hurdles, and therefore it makes it a low chance that that deal would get done.
Thank you, Clayton. For further updates on earnings, make sure you're subscribed to our YouTube channel. This is the Financial News Network. I'm Christy Duffy.